Hi, Harry here on Friday the 17th of November. The market's on crack. I thought that 38% crash in 2022 in the NASDAQ would be enough to knock most of the crack out of these markets, and no, not. And we've seen a continuation of it. 525 basis point rate hike by the Fed, the biggest tightening in 40 years. And a lot of people don't notice this, and I'm going to show this more in the November newsletter again, that the balance sheet has actually dropped about $1 trillion. That's, everything's going against the economy here, but stock market says, no, I want more crack, and they think the Fed's going to start easing anytime. Look, it's not the Fed's normal policy to tighten like this long and then suddenly turn around and ease. I think you won't get an extra, they could have gotten an extra 25 basis points. That does look off the table, so that's a little bullish, but there's no way they're easing until the economy shows weakness. And I think they're going to be easing early next year for different reasons in the market. I think we are going to be heading into a recession. And again, I've shown in the newsletter to subscribers many indicators. They all point towards a recession, even though we're past the demographic point into 2022 and 2023 on margin, where the demographics are still calling for it. But of course, we never had our Great Depression or Great Recession or whatever you want to call it. And again, I am, unlike most forecasters, I am not an enemy of recessions and downturns. We would not have an honest business left in this country or world if we didn't have a recession every decade or so, which we have had since I've been born. So recessions, I've said this before, so I don't need to overharp. Recessions cleanse the economy. It's the boom periods are when the great innovations and improvements in businesses from the downturns, which challenge us as human beings, move into the mainstream. So recessions are necessary. And again, holding off this and printing money for now 14 years straight since 2008, 2009 is insanity. And I think the central banks will be punished for this, but we will see, okay? But, we are at a point where we might see the S&P 500 is just 7% today off of its all-time high back in November 2021, okay? It is possible at this point with the momentum in the market and the slightly good news near term that the S&P will make a new high, and boy, 5,000, the old high was 4820-ish, 5,000 would be a perfect target for that. And that means the other markets would rally. The NASDAQ 100 is only 5% off its high. So what I'm seeing here, there is a distinct chance for the first time here in this rebound that we could get a new high in the leading markets, the largest cap markets, the S&P 500 and the NASDAQ 100, not the NASDAQ 100, the most narrow. And that's always a sign of a long-term peak in markets when the breadth gets narrower and narrower, and all the investors, the less sophisticated investors, piling in just buy the large cap stocks they know, and they get overvalued the most and then therefore crash the most, even though they're not supposed to normally. Now, on the other hand, the NASDAQ, not the NASDAQ 100, the broader NASDAQ is 15% off of its all-time high, and the Russell 2000 is way away, 37% off. So if we do eke out this slight new high in the S&P 500 and also likely the NASDAQ 100, then we will have a massive, huge historic divergence with the NASDAQ and the Russell 2000 and the rest of the stock indices. So that should be the final chapter in the old story. I've fallen and can't get up. Well, I've risen and can't fall down. I mean, this is the market on crack that no matter how hard it gets smacked, it just goes back up to new highs because everybody knows the Fed's going to print more money and support it. Well, I think it is going to be a bigger lag than people think before they start cutting rates, and they will, because the economy starts moving to a recession faster, and then it looks like they're panicking. So that's what it looks like here. I just warned on Thursday in an update, and I gave this update to everybody because I'd given an update to everybody about the Russell 2000 and the Shanghai Composite Triangles. Well, that Russell 2000 triangle broke out the bottom end and then went back up into it again, which told me that's not the most accurate pattern. And now I just put out yesterday an update to everybody saying, look at the Russell 2000 now. It's still the clearest chart. That's why I've been following it. It's had the clearest downturn and the clearest long-term top. And now it's in this sideways channel where it could go back up to as high as 2000, still be way off its, all-time highs, and then come down. And if it breaks 1600, then it's really curtains. And next thing you know, it's down to 1240, the target I showed yesterday. So it still looks like we're in a topping process. People are so used to the central bank supporting the markets no matter what, assuming the Fed will ease very quickly, very strongly, and there is no sign of that yet, and that would not be typical, and they are likely to be behind the 8 ball when this happens. And again, why is that? It's because when you stretch an economy this far, where the long-term demographic peak was 2007, and the long-term technology cycle peak was late 2019, early 2020. When you stretch it this far for years and years, it's just going to go back down harder when it finally breaks. That's why I think the central banks will be behind the 8 ball after they did do this tightening of 525 basis points. So again, markets could reverse anytime. It is a good time to be out, but if you still have some stocks, you might wait and look if we do see this new high in the S&P 500 and this rebound to the Russell 2000. A Russell 2000 back to 2000 would be a really clear final sell signal, or a really, really good signal for investors who want to short this market. Now, everybody shouldn't do that, but if you want to go short, that would be the best signal coming now that this Russell 2000 has formed a more clear channel here, which again, look at the update yesterday on November 16th, and that'll be a good guide. So we'll keep you updated, folks. I am the most frustrated in my entire career over this bubble that just keeps going and keeps getting supported, and when it finally crashes enough to say it's over, still can't quite be over. But again, huge divergence is what I've said today happens. That's going to be hard. The smart money is going to notice that type of divergence, and I think the next downtrend in stocks will be very hard if the other indices cannot follow the S&P 500 and NASDAQ 100 to a new high. So that's what we're looking for now. I hope we don't even get there, but I'd say that's actually the more likely scenario here. A little more percent up, but the S&P 500 another 7% up to get to that new high and 5,000 target. So a little more upside, and then probably harder downside than we saw. Almost certainly this next wave down should be stronger than we saw in 2022. So keep you updated.